We have been talking a lot about playing defense in this market, looking for companies that sleep well at night regardless of what the economy throws at us. And usually, when you want quality and safety, you have to pay a massive premium. So, when you think about defensive stocks, what is the first name that comes to mind? For me, it's Procter Gamble. Welcome back to Manager. Right now, the market is giving us a rare window of opportunity in the king of consumer staples. PG stock has had a rough year. It's down 14% year to date and has barely moved in the last 5 years. But it is the value add. This price drop has pushed their valuation to levels we rarely see. We are looking at a 5% earnings yield on a business that grows like clockwork. Today I'm going to break down the fundamentals and valuation to see if this is a trap or the best defensive play on the board right now. And hey, if you want to know where I'm putting my own money next, make sure to subscribe. Next week I'm releasing my top 5 stocks to buy for 2026. You don't want to miss that. Now, why is Procter & Gamble usually so expensive? It comes down to one word: MOAT. This isn't just a soap company, this is a global branding machine. Procter & Gamble owns 22 brands that generate over $1 billion in sales each. We are talking about Tide, Gillette, Pampers, Crest. These are products people buy whether there is a boom or a recession. Their competitive advantage lies in their pricing power and supply chain efficiency because they are so massive they can negotiate better prices with suppliers and retailers than everyone else. And when inflation hits, they can raise prices without losing customers because, let's be honest, you aren't going to stop buying toothpaste. This creates a predictable cash generating machines that compounds at about 5% annually, almost risk free. It's boring, but it's the kind of boring that builds wealth. Procter & Gamble looks like a very good business. But what are the fundamentals saying about PG? They have a very big market cap. It's a big company, $333 billion of market cap, trading at the forward P around 19, which is around a 5% earnings yield, which is below their historical means. They usually trade at the forward P of 25 to 30, which means 3 to 4% earnings yield. When you look to the forward P ratio, it looks like a very big discount right now, but we'll have to look into valuation next. So into our manager checklist in order to evaluate the fundamentals. They have been growing steadily around revenues around 3.5%. They are expecting to grow earnings per share in the next 5 years around 4.6%, around 5% per year, which is very steady, low growth when you compare to other high-flying companies, technological companies. But this is a very stable business. When you look to revenues, for example, they're growing every single year. Sometimes they grow 1%, sometimes they grow 5%. If you see inflation in the next few years, they will be growing around 5%. So it will be a very stable growth business, but low growth expected. But the word for this company is stable. It is a very stable and very predictable growth. Their revenues are very recurring because of their defensive nature. You will not stop buying toothpaste, household products, for example. So people will buy even though there is a boom or a recession. So no problem. They've been doing mergers and acquisition, buying other brands, doing already launching new products with high returns on invested capital. So that's very good. Returns on invested capital very stable, around 20%. If you look into return on equity, which is very important metric for a company like Procter & Gamble, is above 30%, which is very good. In terms of margins, high gross margins above 50%, profit margin around 18 to 19%, which is very good and healthy, especially for a consumer defensive company like Procter & Gamble. So I really like they have been maintaining margins when you look at that. Gross margins very stable, above 50%. Free cash flow and net income margins around between 16 to 20%. It depends on the year, but they are very stable. Earnings per share growing very slow, but very predictable growth, so that's very good. And shares outstanding going down, so it's something that fundamentally we love to see. So continuing, pricing power, yes, they have the best brands in the business. They have better margins than competition. Their debt is very manageable. They could pay their debt like with 2 years of free cash flow, so very good balance sheet. Their management, their culture, reputation, I love that. You don't see any problems at all. Procter & Gamble always performs very good. Right now, if you look to the graph in the last 5 years, they've been going nowhere, but that's not because the business is doing bad, I would say, because they are growing steadily between 1 to 3, 4, 5%. They are not expecting to grow 10%. Only if there is a spike in inflation, that's bad, but it could have Procter & Gamble, but I'm not expecting that. But very well, Procter & Gamble is a very, when you talk about risks, it's a very, very low risk company, like a risk-free asset. So you don't have to compare, or you could assume Procter & Gamble like a bond. Like right now they have a 5% earnings yield. They are growing organically between 2 to 3%, so it's like 8% return, just like that. You can compare like a bond. They pay a dividend of 3%, and they have been growing that dividend around 6-7% per year, so it is a very good metrics if you look to Procter & Gamble like a bond. And they have a high moat. It's their brand, intangible assets. They have the cost advantage and efficient scale in their competitive advantage. So it is a very huge company. They've been growing free cash flow per share around 2%, but that's because free cash flow is down in the last year, so the growth stalled a little bit. But if you compare to peak trough earnings, for example, they have been growing around 4% per year, which is very good and very stable. They have been returning capital to the shareholders. They pay a dividend of 3%, have been buying back shares when the company it's at a lower valuation. For example, in 2022 and 2023 they bought back 2%. Last year the company was trading at higher valuation. They didn't buy back much of the company, but overall this is a great fundamental company. I love it, very safe. When you talk about defensive, you would think of Procter & Gamble. So question, is it cheap? I'll not say that's cheap, maybe close to fair value looking at these metrics and to the quality, but we will look in depth in valuation right now. It is a good business, one of the best. What did I miss? I don't foresee any problems in the future. What could be wrong in the future? I don't know. I don't have a bear case. So if you have a bear case for Procter & Gamble, write in the comments. I would like to hear about that. So in terms of returns, revenue and earnings growth, it's a yes. They will continue to grow revenues around and earnings per share around 4 to 5%. P expansion, I have a no, but trading at the forward P of 25% earnings yield, it's very low for Procter & Gamble, I would say, though. So they deserve a 25 to 30 forward P, I would say. And they are doing buybacks and dividends at this valuation. I expect them to do more buybacks, so it will be good. So, but is this really cheap? I'll do our discounted cash flow analysis. So it is a US company. In terms of business risk, it's very safe, the safest that is in the equity. So for my best case, I'm using a discount rate of 9.4%. So this is the lowest I normally use, because I'm very happy to hold Procter & Gamble and earn a return of 8 to 10%. That's good because it's very safe. When you talk about risk reward, of course, to invest in Procter & Gamble, I'm happy with 9% return. If I want to invest in a risky asset, for example, a Chinese company, the minimum I would want it to be 14 or 15%, because the risk is much high. It will depend on the risk. So my assumption, future PE 20. I'm assuming a low PE. I really believe they deserve higher PE, but I'm being conservative in the PE. In terms of growth rate, I'm expecting them to grow around 4%. In terms of profit margin, free cash flow margin, around 20%. It's at the high end. They've been having 19% free cash flow margin in good years, but I'm expecting could maintain around that. So between 18 to 20% free cash flow margin is very good for this company. And with these assumptions, I came with an intrinsic value, or my value for Procter Gamble, around $133.8. Right now, the company is trading at 142, so 6% above my fair value. I bought this company last week. It's only a starting position because I really believe this is around their fair value. The price dropped to 138, which is very close to my fair value. If this continues to drop, I will increase my position because I really love this company and I believe this is a very good risk reward. It's far much better to hold like Procter & Gamble than holding cash or a bond. So I'll see that way because this is a very defensive company. I'm not expecting Procter & Gamble to double in the next few years, but it could have a 30% upside potential, I would say. Return to new highs in the next 2 years probably. It will depend on the market, and the downside is very limited right now. And they will be paying a dividend of 3%, which is something I really like in this environment. So to wrap this up, Procter & Gamble is an incredible company with a wide moat that is rarely on sale. We have a recession-proof business, extremely low risk of disruption, and fundamentals that are rock solid. With the stock down 14% and trading at a 5% earnings yield, the risk-reward situation is looking very attractive for anyone who wants stability in their portfolio. It's not going to double overnight, but it's arguably one of the safest places to park capital right now. But I want to hear from you. What do you think? PG stock is still at these prices, or is it dead money? Let me know in the comments below. And remember, if you want to see my high conviction list for next year, hit that subscribe button so you don't miss the top 5 stocks for 2026 next week. Thanks for watching and I see you in the next video. This video is for informational purpose only and should not be considered financial advice. Always conduct your own research and consult with a qualified financial advisor before making any investment decision.